everyone. Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. This is State of the Market. I remember the moment it all changed for me, the direction of my career, how I thought about the markets, everything. I was studying for the Series 86 exam, which is a requirement for all Wall Street analysts. And I was at the kitchen table when suddenly I felt like I'd been hit by a lightning bolt. Suddenly it all made sense. Cash flow was the key to understanding a company's financial health. So why weren't investors paying attention? Most on Wall Street were really only concerned with congratulating management teams after they beat analyst estimates that was based on the guidance that management gave them. So you see how that works. And most dividend investors only cared if earnings were higher than dividends. Now, this is the wrong way to look at a company. Cash flow is a company's lifeblood, not earnings. Now, one of the questions I get all the time is, how do you know if a dividend is safe? Because no one wants to invest in a stock only to see its dividend get cut in half. Well, the answer, as you probably guessed by now, is cash flow. Now, today I'm going to show you why cash flow is important, and next week we're going to get into how to tell if the dividend is safe using cash flow. Now, earnings get all the headlines, but it's cash flow that pays the dividends and funds a business's growth, not earnings. Now, earnings have all kinds of non-cash items in them, things like depreciation and stock-based compensation in its calculation, and earnings can be easily doctored to tell you anything you want it to. Now, a reader of mine had a great quote. He said, "Earnings are an opinion, cash flow is fact." Now, here's what I mean. When you figure out earnings, you take revenue and you subtract all the expenses like costs of goods sold, SG&A, which stands for sales, general, and administrative, which includes things like salaries and market costs and the water in the water cooler. You subtract interest expense, taxes, and a variety of other costs, but you also subtract things that didn't cost the company any money, like depreciation. So if a company buys an expensive piece of equipment, it takes depreciation expense for a number of years, but that is not cash that is flowing out the door in the year the depreciation expense is taken. Additionally, if a company gives employees shares of stock, that's subtracted as an expense. But again, no cash went out the door. Here's another one. If accounts receivables decline, that means cash came into the company, but, and this is a big one, it most likely won't add to revenue or earnings because companies can usually book revenue when the sale is made, not when they're paid. Here's what I mean. Let's say on December 30th, a company enters into a contract to sell $10 million worth of widgets. That $10 million is counted as revenue, which trickles down to the bottom line and increases earnings. But the company hasn't received a dime. As of December 31st, that $10 million is an accounts receivable. The $10 million would be subtracted from cash flow. So when it reports its earnings ending on December 31st, revenue includes that $10 million sale and earnings increase, but cash flow will not because it did not get $10 million in cash. Now on February 1st, they get paid the $10 million. Now at this point, it has no effect on revenue or earnings because that's already been counted for last year. But you can't just pretend you didn't receive $10 million unless you're Wesley Snipes. So it's counted on the cash flow statement when accounts receivable declines by $10 million. Now you might be thinking, well, that sounds like an easy way to manipulate earnings, and you'd be 100% right. Let's say a CEO is under pressure to deliver strong numbers and things aren't looking so hot in the December quarter. He calls up a customer or wholesaler and says, "I need you to take $10 million worth of product right now." And he gives them favorable terms, or maybe he says he's willing to take back whatever doesn't get sold. That's a next year problem. Right now, he's got to make his yearly numbers to keep shareholders happy and to get his bonus. So the wholesaler buys the $10 million worth of widgets. The company counts it as revenue and earnings. Meanwhile, it hasn't received $10 million for those widgets, but most investors don't care because the company reported strong earnings and the stock went up. CEO gets his bonus, sells some shares, and everyone is happy. Everyone, that is, except investors smart enough to analyze the statement of cash flows who realize that although earnings went up, cash flow did not. It's not going the same direction, and that can be a sign of fraud. So you can see why I felt like I had an epiphany when I realized the importance of cash flow. So now that you know how important it is, next week we're going to dive into how I use cash flow to analyze the safety of a dividend. Be sure to check out my free e-letter, Wealthy Retirement, for all things income and retirement related. Just click on the link below, and I will see you next week on State of the Market. Thanks for watching.